afterwards. Whether we'll send it by email, put it on YouTube, we don't know. Anyway, welcome everybody to our seminar, titled which is whether the side-by-side agreement will work. We've had a lot of interest on this topic, and thank you to Professor Reuven for agreeing to talk to us about this, and thank you to Christos for actually he was inspiration behind this project. He told me a couple of weeks ago we should do something about this and we should invite Professor Reuven Avi-Yonah. And I said, oh, there's no way we can organize it. And well, indeed, we have. So I'm very thankful for both of you for very quickly coming around and agreeing to this event. The side-by-side agreement is a very important development. I was actually reading at how this might affect what the impact of this will be in the EU, and whether some of the one pending reference to the Court of Justice on the UTPR is actually going to fail, because one of the reasons is this side-by-side agreement. So it's going to be a very important, it is a very important development. It's likely to be even more important in the future. With us today, we have Professor Reuven Avi-Yonah, who is a leading professor, not just in US tax, but international tax law in general at Michigan Law School, also formerly a consultant at the US Treasury and the OECD. I remember reading some of Reuven's iconic, epic articles. I think one of them was a single tax principle, a very long time ago. The one was in the Harvard Law Review, I think you wrote that, or when you used to be at Harvard. And I remember at the time saying, we will never see a single tax ever. This is so this is a dream, and it has happened like 20 years later. We're talking about Pillar 2. We're talking about a minimum effective tax rate. So a lot of research that Reuven has done is quite pioneering, and I think he's proven right in more than one occasion. I would also like to introduce, to those of you who've been with us to other events, to reintroduce Christos Theophilou. Christos is a partner at SCI Taxand in Cyprus. He's both a lawyer and a chartered accountant, and he teaches our Pillar 2 Executive Education course at Queen Mary, which is about to end. And as we're going to announce at the end of the course, we're running a new, bigger course in the new year on Pillar 2, and another one on transfer pricing on financial transactions. So I think Christos, because Christos has managed, again, within a couple of months preparation to organize and to deliver a great course, a very popular course. Thank you very much for everything you're doing for us at Queen Mary. So without further ado, I will let Christos, you're going to introduce the topic, and then Professor will talk. Is that, however you prefer this?
Yes, excellent. Let me share my screen in order to be able to share the slides. Do you see my screen, Christiana?
Yes, I can see your screen, yes.
Excellent, excellent. So good afternoon, everybody. If you are in the US, good morning. If you are in Europe, good afternoon. And if you are in Asia, good evening. My name is Christos Theophilou. I am one of the partners of STI Taxand, and today we are going to present whether the side-by-side can work. Pleasure to be here with Christiana and the whole team of Queen's Mary. Thanks for the invitation, and thanks to Professor Avi-Yonah for bringing his insights to the side-by-side. Before we move on to the insights of Professor Avi-Yonah, I will introduce you to how CFC rules work in practice and how the IIR compares to the US GILTI, and whether these are similar or not, and whether there is a possibility of the side-by-side to work, of course, if they are similar. So let's dive into the practical details. Post-BEPS, we have an excellent report, which is the BEPS Action 3 report, which is about CFC rules. If you can click on the slide, we're going to circulate the slides after we finish, is that you will be able to see that it defines that CFC rules, they are there in order to respond to the risk that taxpayers with controlling interest in foreign subsidiaries, they can strip up the base of the country of residence and therefore hide taxes. The OECD recommends 6 building blocks in order to design effectively CFC rules around the globe. The first building block is the definition of the CFC rule. This is the personal scope, which entities are included in CFC rules and which are not. Then there are some exceptions, some de minimis exceptions, or some other tests. The third one, building block, is the definition of the CFC income or the sole tainted income. Maybe it's active or passive or something else. Finally, how do you compute the CFC income? Typically, this is based on the domestic law of the shareholder, of the residence of the shareholder. And finally, if you have any income to tax, the key question there is about how you are going to attribute the income. Typically, this is your participation in that foreign subsidiary. And of course, you need to account for the prevention and elimination of double taxation because you are taxing an income that effectively it will be taxed again at a later stage. So these are the 6 building blocks that the OECD recommends for any country that wants to design an effective CFC regime. And let's, of course, dive in now to the details about how the OECD Pillar 2, the non-income inclusion rule, the IIR, compares actually with the US GILTI as we know it today. So let's start with the first comparison, which is the policy objective, kind of different policy objective, I will say. The aim of the Pillar 2 and the IIR is to stop the race to the bottom, to the 15%, and effectively they want to curb profit shifting of the global, they need a floor to the global minimum tax for multinational entities. However, for the US GILTI is kind of different. It's initially aimed to discourage the base erosion of US multinational, and therefore it's a unilateral approach rather than a more coordinated approach that we have under the IIR. Now, if we compare now with the OECD IIR for the personal scope, I mean, who is in scope, we see that for the IIR applies for many groups that they are big groups that they are doing country by country reporting. Typically, their consolidated revenues are 750 million and above, and it applies a top-down approach starting from the ultimate parent entities. And of course, we also have excluded entities. Whereas on the other side, it applies to US shareholders of CFC rules that they have a controlling interest or lower. So the controlling test is different. Here we have a consolidation control test, a very higher level, whereas here we have a different controlling test that we have in the CFC rules of the US. Now, the structure of the rule is kind of different again. Here, the IIR, we have a coordinated international CFC rule. You all know that we have all these switch of rules of the top-down approach. The IIR applies first to the UPE, then to the intermediary parent entities. We have all the POB and so on. Whereas on the other hand side, this is a unilateral CFC regime, is not coordinated. It only applies to the US and there is no coordination, although the OECD considers the US GILTI as blended CFC income for the Pillar 2 interaction. Now, as I mentioned earlier, the approach of the OECD IIR is a top-down approach, whereas the US GILTI is the entity-level approach. It's a bottom-up approach. If you are a CFC from the bottom up, then you stop there and you're applying the CFC rule. Now, then you move on to the material scope. What is the target income? What income we are taxing here? The globe income effectively is all globe income that derives from the accounting standards. Here we don't follow the tax rules. We all know that the globe rules, they heavily rely on accounting standards. Anything that is income is included in accounting, is included in the IIR computation. Of course, there is a carve-out of the routine profits test. So if you fall in the substance-based carve-out, which is your payroll and your tangible assets, then you have a routine test of 5%, which is excluded from the GloBE rules. Whereas in the US GILTI side, you have the net CFC tested income, which effectively we know that the qualified business asset investment is eliminated from 2026 and onwards. Now, another key question, which is one of the big questions, I would say, how much? What is the headline minimum tax? Here we have a 15% minimum effective tax rate, whereas with the new rules in the US, it is approximately 14% the effective tax rate when it comes to the US. One of, I will say, and it will also be a discussion right now in the OECD, the biggest key issue, I will say, is the blending rules. We all know that the IIR applies on a jurisdictional basis. So the blending is based on each jurisdiction. We need to do the calculations for each jurisdiction. Whereas for the US GILTI, there is a global blending rules. It does apply to all constituent entities together. So you don't apply these blending rules for a jurisdictional basis. Now, for the OECD Pillar 2 rules, we have the so-called qualified domestic minimum top-up tax that takes priority for any other jurisdiction, whereas there is no US qualified domestic minimum top-up tax, although the US has its own global minimum top-up tax, which is the 15%. As I mentioned earlier, the ordering rule and backstops, the IIR, the GloBE rules, they have their own ordering rule, a coordination rule. You apply the IIR first. We also have the POPs and so on. And at the end of the day, if nothing applies, you have the backstop, the UTPR, that applies at the end of the day in any jurisdiction within the MNE group, it can apply the UTPR. Under the US GILTI regime, there is no UTPR similar to the US law. And we all know that the UTPR is something that the US is very against because it can be argued is extraterritorial. So one of the big difference, of course, is the UTPR provision. Another thing to note is that the IIR, the GloBE Pillar 2 rules, they have de minimis reliefs. So we have the jurisdictional de minimis election of 10 millions of revenues and 1 million of profits with a 3-year look-back period. And of course, we all have all these safe harbor rules that the OECD develops. And we are also expecting the permanent safe harbor rule to come up before the year end. On the other side, there are no de minimis thresholds similar to the IR within the US GILTI. Again, there is no substance recognition. In the IIR, we have the substance-based income exclusion rule, where certain routine profit test is excluded from the CFC income, whereas the qualified-based income is excluded from 2026 and onwards when it comes to the US GILTI. More or less, when you go to the tax-based mechanics, what is the tax base? As I mentioned earlier, the IIR is heavily based on financial accounting profits. This is a starting point, and there are certain adjustments that they're allowed, not more. I think it's like 20 adjustments, more or less, when it comes to the GloBE rules in Chapter 3, whereas for the US, you follow the US taxable base to calculate the US GILTI. Again, also about timing rules and double tax relief. Of course, under the IIR, you need to do your annual calculation. There is a loss carry forward, and there is also a deferred tax mechanism applied in the GloBE rules, which follows the deferred tax accounting standards that you find in IFRS and so on. Whereas from the perspective of the US, there is no similar deferred tax accounting and the like. Now, interaction with other US groups. There is, without any special arrangements, there is not an equivalent coordination, as I mentioned earlier. And for timing difference and losses, again, there is a deferred tax mechanism and loss carry forward when it comes to the IIR, whereas there is no similar when it comes to the guilty US guilty rules. Finally, last 2 points from my side before I hand over to the floor to Professor Avi-Yonah. There is a safe harbor rules. I mentioned 3 safe harbor rules when it comes to the globe rules and transitional relief that was introduced by the OECD. And of course, there is interaction with domestic minimum top-up tax, whereas this is not the case with the US. So I hope that I tried to cover as much as possible the differences between the 2 regimes. And let me hand over back to you, Christiana, to pick up the more, I will say, expected discussion here from Professor to see how these 2 can coincide together and have a side-by-side system in the new international tax arena.
Thank you very much, Christos, for this very useful contrast. A lot of people, well, I'm one of them, not experts in the details of either regime. So it's very useful to get this snapshot of the differences. Very interesting to see what Professor Reuven has to say about this and how the G7 agreement fits in. So without further ado, Professor, I'll give you the floor. We can't hear you. I think you are need to switch on your other device.
Hear me now?
Yes, we can hear you
Okay.
now. Yes.
All right, so let's talk about how this side-by-side agreement might work. So basically, the history is that when the Trump administration came in January, they announced on the first day that they're very much opposed to Pillar 2 in general and to the UTPR in particular. And legislation was introduced in Congress to penalize countries that apply the UTPR to US multinationals. And that legislation was part of the OBA as it passed the House of Representatives. And then on June 26th, Secretary of the Treasury Bessent announced that he had reached an agreement with the G7 to basically exclude the United States from the scope of the UTPR in particular, so that it will not apply to US multinationals. And so that's created a side-by-side situation where the US multinational will be subject to the US rules that were explained by Christos, and EU multinationals and other multinationals will be subject to the Pillar 2 rules, including the UTPR. So the question fundamentally now facing the OECD and the EU is whether they will go along with that, because this was an agreement with the other members of the G7 and not with the entire OECD or the entire inclusive framework or the EU. And my contention is that they should go along and should accept this situation. And the main reason is that I do not think that the differences, and there are differences between the US rules and Pillar 2 create a competitive disadvantage to non-US multinationals. And in fact, I would argue that the regime that applies to US multinationals is tougher than the Pillar 2 regime. And therefore, if anybody is at a competitive disadvantage, it's the US multinationals, although I think they're doing pretty well in today's world and they don't really need tax breaks. So let's talk a little bit about what that may be the case. So there is one, as Christos mentioned, there is one big differential between the American rules and Pillar 2 that seems to work in favor of the US multinationals, and that's this whole blending or averaging phenomenon, because Pillar 2 applies country by country, and guilty / NCTI and the corporate return minimum tax both apply on a blended and average basis. So you can take countries with a tax rate above 15% or 14% and average them with countries below that, and end up with a blended or average rate that reaches those rates overall. That is, it has to be 14% on taxable income under GILTI and NCTI, and it has to be 15% on book income under the CAMT, but it's the possibility of averaging. So my argument would be that two things. First of all, as a matter of competitive advantage or disadvantage, what matters primarily is the overall effective tax rate of the group. That's the number that appears in the financials. That's what tax directors look at when they compare how they're doing compared to their competitors. And under both regimes, essentially the tax rate is the same. That is, the CAMT rate is exactly the same rate and the same base, more or less, as the Pillar 2, because it's book income and 15% on the entire multinational. And the GILTI NCTI rate is 14% with foreign tax credits, and it will basically, with averaging, it will always be 14% because there are always enough foreign tax credits somewhere to get to 14%. So that's the rate. And that I think, is what will apply to American multinationals, and I think those are sufficiently the same. Now, where averaging comes in is in the choice of where to make a new investment, whether to put it in a low tax jurisdiction or in the United States. It's about profit shifting. So if you're a US multinational in what's called an excess credit position, meaning you are already in a country that has a higher tax rate than, in this case, 14 or 15%, and you have the choice between investing in the United States and investing in a country that has a lower tax rate than 15%, and on averaging, you will choose a country with a lower tax rate because then you can average, whereas you can't average with the United States because the way the foreign tax credit works is that it only applies to foreign source income. So American source income is not going to help you get rid of the excess credits. So that's the advantage of averaging from multinational perspectives. That's a disadvantage of averaging from a US perspective because it encourages profit shifting. And of course, it also encourages countries to be low tax country vis-a-vis American multinationals. Doesn't necessarily mean, I think, that they have to be low tax country vis-a-vis an EU multinational, because it may be possible to have some kind of deal with American multinationals that reduces the tax rate just for them, although that remains to be seen how the OECD will deal with the situation as far as what qualifies as a QDMTT for Pillar 2 purposes. But even assuming that that can't be done, a country that cares primarily about American investment, let's say, has an incentive to have a low tax rate below 14% in order to benefit from the average. But still, even with that, it doesn't put the US multinational in a competitive advantage vis-a-vis the EU multinational because the overall rate is going to be the same regardless. And the second point is that this analysis only applies to US multinationals in an excess credit position, meaning somewhere in the world they're paying more taxes than 15% or more taxes than 14%. And more American multinationals are not in that position. So when the TCJA was enacted in 2017, the corporate tax rate was dropped from 35 to 21. And even though a lot of multinationals did not really pay 35 and paid much less on foreign source income, nevertheless, there was a time where quite a few American multinationals after 2017 were in fact in an excess credit position because they were invested in countries with a higher rate of 21, which is the US tax rate times foreign source income that determines the foreign source credit. And under 2017, the GILTI rate applies worldwide. So you don't have deferral anymore. Everything gets taxed currently. And so if you're over 21, you get excess credits. And you can't, as Christos mentioned, the current credits, you cannot move them back or forward. You have to take them in the year that they are earned. But by now, we're now in 2025, American multinationals have adjusted. And basically, I don't know too many American multinationals that are in excess credit position because they already took advantage of averaging opportunities that exist. And so what happens then is that you basically cut down your rate to 15 or 14, and you make sure that that's the rate that you pay globally, and you're not going to pay anything more than that. Now, of course, on US source income, you pay 21, unless it's export income, in which case you also pay 14, because we also have the so-called PIGI regime, the foreign derived intangible income, which gives a tax break for export income. But in any case, you generally pay 21 on US source income, and you pay 15 or 14 on foreign source income, depending on whether you're in the CAMT or the NCTI regime, globally, worldwide. And that, I think, is what the situation that most American multinationals are in. And if they already are there, then it is not going to help, let's say, Singapore to drop its rates dramatically below 15, because they'll then be hit with the potentially hit with the UTPR or the IR for Europeans. But in addition, for American multinationals, it's not going to attract more investment, because this attraction only exists if you're in excess credit position, and I think most of them are not. Same thing, by the way, happened in 1986 when the US tax rate was cut from 46 to 35. And for a while, a lot of countries had a higher rate than that, and US multinationals were in excess credit position. And by 1995, this we know from IRS statistics, none of them were in excess credit position anymore. Multinationals are really good at this. They don't like excess credits. They especially don't like excess credits that they cannot carry forward or back, and they lose them. So they do invest a lot of resources in tax planning to prevent being in an excess credit position. And when you're not in excess credit position, the averaging doesn't matter anymore, which is, I don't think that's such a big deal. Now, let's look at the other side. There are elements in the Pillar 2 rules that are really beneficial from an EU multinational perspective, or a Chinese multinational perspective, or other multinationals that are not US, and that do not apply to US multinationals. The most important ones, I think, are the SBIE, the substance-based income exclusion, and the qualified refundable tax credit rules. So the SBIE allows you not to count towards the effective tax rate for QDMTT purposes a certain percentage of your tangible assets and your payroll. And that simply means zero tax on that, basically. So if you have an actual factory with actual workers in Singapore or any other, low tax jurisdiction, you get away with it, and it still qualifies as a good QDMTT, even though the real effective tax rate is below 50. So that's one. The other one is qualified refundable tax credit under the Pillar 2 rule. If you have a qualified refundable tax credit, meaning you pay back cash over a certain period of year, I think 4 years, then that doesn't count to reduce your ETR. It only counts as income to the investor, and that's a much lower reduction of the effective tax rate, and if it counted as a reduction of the ETR. And some countries have, of course, been benefiting from that, and Singapore is one of them, which is why I mentioned them. But Vietnam and many other countries now have QRTC regimes under which they basically give some of the money back from the QDMTT to the investors, and that way they still attract investment, and their effective tax rate again goes below. Neither of these things apply to an American multinationals, because as of now, this year, that is basically as of 2026, there is no QBAE, Qualified Business Asset Investment Rule. So the way it worked under GILTI was that the first 10% of return on tangible assets was exempt, and now there's no exemption anymore. This was deleted this year, so all income is subject to the 14% period. It doesn't matter how many, and the rationale for that was simply that the former rule encourages the actual movement of jobs out of the United States. So I think it was correct to abolish it. And we don't have a qualified refundable tax credit mechanism either, because we have a foreign tax credit regime, and if you have a refund of the amount that you pay in taxes, that eliminates the foreign tax credit. You can't have a refund, you can't have a subsidy, you can't have anything like that. The rules are pretty clear and pretty tough. So I would say that because of these two features, the American regime has the same rate as the Pillar 2. In the case of the CAMT, it has the same base also, and there are base differentials, but they can go both ways. But because of the lack of a qualified SBIE type regime, and because there is no qualified refundable tax rate regime, the actual effective tax rate is likely to be higher. And so then let me just mention one thing, that people have done empirical work on the comparative effective tax rate of US and EU multinationals before and after the TCJA. I don't know anybody who's done the work now because these rules are really new, but it will take a while. But people have done it based on historical data. And the finding before 2017 was that basically the top 100 EU multinationals and the top 100 American multinationals had basically the same tax rate, even though the tax regimes are really different, because in the EU you had more or less territoriality, that is active dividends from the active income of CFCs were not taxed, and you had different CFC rules, and some countries did not have CFC rules at all. And the US had CFC rules, but they were not working very well, and because of check the box and so on. So as a practical matter, in both countries, you had a very low tax rate on foreign source income and a much higher tax rate on domestic source income, and it averaged out. And it was the same after 2017. No big difference after 2017 either, and I suspect it's going to be the same now with Pillar 2 and these rules. Maybe the American will pay a little bit more, but not tremendously more. Now, let me say one final thing that I wanted to say, which is this concept of side-by-side is something that has been in tax rules forever, and not just in international tax, but in general, the US has always been different than the rest of the world in some ways. Just to step back to real basics, we don't have a value-added tax. There is no other country in the world, basically, that doesn't have a value-added tax. We have no federal consumption tax at all. That's a huge policy difference, and it seems to work fine, even though there are good arguments that the value-added tax is, in fact, an export subsidy. And the Americans are not happy with it, but it seems to work now. So now there's tariffs and stuff like that. But in any case, that is a very big difference. Another example is we have a classical system of taxation. That is, we have a double tax. We tax the corporation, and we also tax shareholders and dividends. Most of the world has integrated methods. They don't tax dividends, or they give imputation credits, or they do something to relieve the double tax of corporations and shareholders. We don't. That creates tensions when you have cross-border investment, but they're manageable. It's side by side. But now to go to the international area, countries are used to be, certainly, and still are, many of them, more territorial than the US. The US is a worldwide system. They have a territorial system. It works side by side. There's Article 23A, there's Article 23B in the model, and so on. There is the different models. There's the UN model, there's the OECD model, there's the US model. They work side by side. And there is a limitation on benefits compared to the primary purpose tax in the MLI. And so on and so forth. There is endless side-by-side arrangements in international tax, and they work fine. And my prediction will be that even if the UN framework happens, it will work side-by-side with the OECD. It's not the end of the world to have side-by-side arrangement fundamentally, although it's important to know the details, of course. And I think by and while, all the people who have said for a long time and repeat saying that Pillar 2 will collapse because of this, I don't think this is going to happen. I think Pillar 2 will do fine and will remain. And I think the American rules will also do fine. I do think, however, that my hope is, Pillar 2 was built to some extent on GILTI. That is, GILTI happened first. GILTI was enacted in 2017, and that is what inspired the OECD to adopt Pillar 2. Because if the Americans can do it, other people can do it as well without putting themselves at a competitive disadvantage vis-a-vis the Americans. Now, at the moment, as I said, again, the American multinationals are facing tougher rules than the EU multinationals. And I think what I would hope is that the OECD will now reconsider the substance-based income exclusion and the qualified refundable tax credit, because I think those are both unjustified and they're political deals. I mean, the fundamental question is, do you care about tax competition for real stuff or just about profit shifting? That's the issue. And basically what the OECD is saying, we only care about profit shifting. We don't care about tax competition for real stuff. But tax competition for real stuff is important because it attracts the real movement of jobs away from the high tax countries towards the low tax countries where they benefit from a zero tax. And I don't think that's justified either. One final point. There is still, I think, and this is something that Christos mentioned, but I want to highlight it. There is a fundamental difference between the American rule and Pillar 2. And the fundamental difference is this. The American rule is a foreign tax credit system, meaning if the source country does not tax, the United States will tax. And that's true now globally. It's true for the CAMT, it's true for the NCTI. And unless there is a source-based tax, we're going to pay American tax. That's not true for Pillar 2, because a QDMTT turns off the IR and the UTPR completely. So it becomes a territorial system, assuming you have a valid QDMTT. And the problem is that this, in my opinion, gives too much power to the source jurisdiction to fiddle with the QDMTT rules, and in a way that would still turn off the IR and the UTPR, and yet result in a significantly lower tax rate than 50%. And that's what the SBIE is about, and that's why QRTC is about. And you can also play with transfer pricing and how much income exactly is included in the source jurisdiction that is subject to the QDMTT, etc. So I think, again, the American rule is, in my opinion, better, because it really, the foreign tax credit really doesn't give a foreign tax credit unless there actually is a tax paid to the source jurisdiction. And I, since, as Christiana mentioned in the beginning, I believe in the single tax principle, I think that is more consistent with the single tax principle than Pillar 2, even though Pillar 2 obviously is a big advance towards the single tax principle. And with that, let me stop.
Thank you very much for a very interesting presentation. I think it's based on I've read your article that is going to be published in the tax notes, if I'm not mistaken. So these professor's arguments are very convincingly put in his article, which is forthcoming, and he can share with us once it's published. I was very
December 8th. So
December
the
the 8th.
On December 8th, this will be up.
Excellent. So, and if you allow us, if you give us a PDF, we can send it off. So I'm very surprised by the arguments that you made. Not surprised, but sort of the fact that it seems like competition is building up in another manner through this new distance of single tax or minimum tax. There is competition, and it all goes down like the rules of the game have just simply changed. It's different type of competition, and different types of credits or incentives that are now going to be allowed. It's a very interesting argument, and also the where you presented like the CBIE is going, that is problematic from a US perspective. I don't know if Christos has something to say about this, and we can open the floor for questions as well. So just a very interesting presentation, and I think from what I've read on some sort of unofficial documents circulating, what is happening from a US perspective is actually greatly influencing what will be argued at the Court of Justice for the pending referral, and how the US multinational is being affected or not. So there's a lot coming up on this as well. Do we have any questions or anyone who wants to say something? I'm just trying to see if I have any raised hands. Christos, would you like to say something?
Let me say something that Professor Avi-Yonah explained it very well. And I think the biggest issue here, I think it's the first row that I included in my slides, which is the policy intent. The policy intent of Pillar 2 is to stop the race to the bottom and stop shifting profits in tax havens and low tax jurisdictions, which this is fundamentally different from actually the US policy intent. And that's why the two is difficult to be coincide, because you are trying to do different things. And the OECD gives, the substance-based income exclusion, the carve-out, the qualified refundable tax credit, in order to give the incentive to jurisdictions to get in order to apply this stop competition, the race to the bottom. So the OECD is giving a lot of incentives, and also that's why it included the qualified domestic minimum top tax. We know that the rules at the beginning, the QDMTT was not there, and it was included afterwards. So all these in brackets benefit, it's benefits that the OECD is providing to countries around the globe to actually give them the incentive to join Pillar 2, and that's why we have the UTPR. UTPR, I don't expect that countries will collect UTPR, but it's a backstop, it's a shotgun on the heads of the tax authorities. If you don't tax, I will tax. So all this is happening for another reason in the OECD. The US, of course, they did it first for another reason, and now they are trying to mirror these two, which I totally understand what Professor Avi-Yonah saying, that the US guilty as it is right now, in many circumstances, it will be more and more disadvantaged than the IIR. So, but again, on the other side, someone might say that, but the effective tax rate on the one hand is 15%, the other one is 14%, or you have jurisdictional blending, or you have global blending, and how this will work. And hopefully there is a solution. I mean, we are expecting this before the year end. So let's wait and see. We hope that we have, and I'm definitely, this is always the case. I mean, since the first international tax system, always the US was side by side on everything. So no one expects that the US will join Pillar 2. We have never expected this at the beginning. I mean, we know that the US does not sign multilateral instruments, it's always bilateral in treaties, and all the exchange information and all the international tax arena, always the US, it was bilateral. So I think that the OECD knows that the US will never join. I mean, a person that reads history of international tax, this is the first thing that you will learn.
I mean, I have a question, and we have a question from the audience as well. I have a question right on the point that you're making. It's actually for Professor. Given how guilty might actually be more disadvantageous, like at least minimally, do you expect that the side-by-side agreement is going to be the end of this, or do you expect more from President Trump's administration, like more coming back and saying, actually, this is not good enough, we want more? What do you think? Do you think this has appeased the Treasury, or is this just round one, basically, and we should expect round two soon or next year at some point?
Of course, I mean, this is impossible to predict, given that it's a Trump administration. But I think as far as Congress, at least, is concerned, they will be pleased with the Pillar 2 side-by-side agreement, because that's why they dropped the so-called revenge tax. The Republicans in both houses agree that it's not necessary anymore. And I found that interesting, because the revenge tax had another target, which is not off the table, and that's digital services taxes. A lot of countries have them, and many other countries are considering them. And this is something that the revenge tax also targeted, and dropping it means that countries now at least can adopt those without being concerned about Section 899, even though, of course, there's also tariffs and other ways. I mean, so far, Canada and India have dropped their DSTs, but other countries, including countries that have struck deals with the administration, like the UK, for example, and the EU and other countries, have not dropped the STs, and they are continuing to collect money from the STs that are grandfathered. And Pillar 1 is now dead, and so as a result, more countries will do that. And that, I think, is a more potential source of problems than this side-by-side agreement, which I think is fine, because the truth is that American multinationals are used to dealing with these rules, even if they're slightly tougher than some of the other rules. And the abolition of Cuba, for example, was something that the Republicans did. They also did not touch the corporate alternative minimum tax, even though that was something the Democrats enacted in 2022, but it brings in a lot of money. There's also always the consideration of how much revenue they need, and the United States needs revenue because we have a very big budget deficit. And so I suspect that there will not be any move either by the administration or the Republicans to change the side-by-side agreement, assuming that it gets approved. I think there may be problems with other tax areas, specifically the DSTs, but we will have to see.
We have two questions from the audience. One, John Ebanks saying, any specific reason why certain offshore jurisdictions have decided on the Pillar 2 and others have decided against it? Bermuda, Dubai versus Cayman, for example. That's one question. And I think with that to this, do you expect other jurisdictions demanding side-by-side, or is it just a US privilege? I think this question is both for Christos mostly. And the second question is, will the country say they will not accept UTPR, saying no jurisdiction? Well, yeah.
Christos, you like that better for you.
Yeah.
Is that better for you? Yes.
I don't mind. And Professor, you can also comment on this. From starting from the side by side, we all know that there is two major economies that they haven't joined Pillar 2, which is India and China. So a lot of people, they believe that maybe the side by side agreement will open the Pandora box, meaning it will open the appetite of India or China to also implement the side by side system. So this is something that we might see in the next couple of months. Now, for why some jurisdictions they join and some jurisdictions they have not. I mean, we all know that all the offshore jurisdictions right now, they are feeling this pressure in order to implement the Pillar 2 rules. We all know that the reason that we have Pillar 2 is because Pillar 1, BEPS 01 failed in order to stop the race to the bottom, in order to be able to tax the multinationals, and that's why we have Pillar 2. So there is a big pressure on all these jurisdictions for the last 10 years to implement these rules. So I will say that this is a jurisdictional decision. So I will say, for example, the Dubai and Bermuda, they choose to do it. Maybe the business that other jurisdictions that they are actually doing maybe is not that affected, or maybe they don't mind if someone else is taxing them. So this is a jurisdictional choice. About the UTPR, we all know that the UTPR, a lot of people claim that is discriminatory or extraterritorial, which is. But can you prove this under treaties? Maybe no. Or under the EU law, which we all know that Americans have filed in the Belgium court, and we all know that we are expecting this very important decision whether the UTPR is discriminatory. But will countries they cannot accept it? Yes, a country say cannot accept it, but at the end of the day, what can you do? I mean, what can you do if, for example, an EU jurisdiction taxes you and you are, I don't know, in the other side of the Atlantic, or you are in Asia? How can you do that? I'm not quite sure if there is something that you might be able to do, and I don't expect that actually this will be a problem, because from all these ordering rules, I mean, QDMTT, IIR, top-down approach, I don't see, and I don't expect personally big amounts of UTPR tax in the hands of jurisdictions. So I will say, even if they don't accept it, the amount will not be that huge to fight against it. And I don't know what are the means fighting against that UTPR.
Yes. Interesting point. We have a comment by Deus Mugabe, my PhD student, saying that although the guilty and FDI are close to 15%, as they were raised to 14% in 2022, the US corporate AMT regime taxes large MNEs at a rate of 15%. So in practice, US large multinationals will pay at least 15%. So I think this buttresses Professor Reuven's argument that the guilty is, if not equal, more disadvantageous than IIR of the Pillar 2 rules. And actually, the side agreement was a bare minimum that should have been given to US on this, to prevent any revenge taxes.
Right, and this is important because there have been quite a few stories in the press recently about a lot of big American multinationals that pay the California minimum tax rather than the regular tax, meaning they're 15%. It's 15% on their total global income, including the US. And because there are all kinds of tax breaks and that go into the calculation of the regular tax, it is quite likely that a lot of US multinationals actually are paying the 15% global, and that's the same rate and the same base as Pillar 2. So I think that we're actually moving towards convergence in this direction, because I imagine a lot of EU multinationals and other multinationals are, also going to be paying 15% of global income in the future, especially with the UTPR. Now, India and China may be special cases because China is only beginning to have its multinationals expand overseas. I mean, there are some that have always been like Huawei, but Alibaba, for example, has only recently entered Europe and they're not present in the United States at all. And so the more they expand, the more they're exposed to the UTPR. And it'll be interesting to see what China does about that. Maybe, as you say, they will negotiate their own side-by-side agreement. It's certainly possible.
Maybe there will be a follow-up event discussing what China and India will do in 6 months' time. Very, very interesting times, international taxation. Seems like we've been on a very high fast-track train since BEP started, basically. It's just relentless. We have another question. We're just trying to get this. I think this is more, Christos, I don't know if this is a good time to answer it, if you'd like to have a look at the question.
Sorry, I was on mute. Let me read the question for everybody's benefit. I would like to ask you information on the commercial constituent entities enterprises that are owned by investment funds that overpass the threshold of 750 million revenue, but that as investment funds are excluded. There is little information about these cases and Pillar 2. Can you give us some info about these topics? Yes, so there is certain investment entities that they are excluded from the Pillar 2 rules, and whether they are excluded or not, this might mean that you are benefited from the rules. So I will say that you need to see the definition of whether you fall under the rules of investment entity, because there's a certain definition of what an investment entity is and what an investment entity is not. And if you are an excluded entity, it is not, you are outside the scope of Pillar 2. But if you don't qualify as an investment entity, then it means that you are not excluded and you should be in scope. So I'm not sure what exactly is the question, Carmela Marina. I mean, there's little information about these cases. The little information is whether you are included or not, or how you are calculating your income and what will be your effective tax rate. I'm not quite sure about the question. So what I understand here is that you need to consider whether you are, you need to see if you meet the definition of the investment entity or not. I think this is the most critical question.
I also think, without being an expert in this area, this also raises the issue that there could be exceptions in Pillar 2 that are not in the US regime or following the side agreement, so they could, which again gives an advantage when you have the EU parented multinationals compared to the US. So I don't know how the US would treat this or whether such entities would be exempt, but there are exemptions, there are safe harbors in Pillar 2, which may not be the same in the US. So again, that's another way where competition rises between the two regimes, and there is a comparison. Any final comments, Professor Reuven?
I mean, I think this is a rapidly evolving subject. Hopefully we will have a decision on Pillar 2 and the side-by-side regime soon. I know that there are discussions going on at the OECD now about how exactly to respond to this, and I very much hope that we will not have a tax war in 2026 as a result, because if this is rejected, then I think the whole revenge tax stuff will come back again. The Republicans have the ability to pass more tax legislation next year, and they're probably going to do something before the 2026 election, because it's a possibility that they would lose control of Congress at that point, and if they want to do something, it has to be in 2026. But they certainly have already said that if the side-by-side agreement is not approved, they will revive the legislation, and I very much hope that's not going to happen.
Yes, very interesting. How about you, Christos? Any final comments?
I think my final comment, which is I think the discussion that held at IFA is that a lot of people are opposing against Pillar 2, but the feedback coming from the OECD is that this is the rules. We are going to follow the rules. get used to it. I think this is what was a discussion. Let's move on. I think there will be an agreement with the US by the end of this year, and starting from 1st of January 2026. I will say that all this discussion is expected to end, and then we might change the discussion whether another country like India and China might join the side-by-side rules. Of course, in life, we everything is unpredictable. We don't know what we'll see next. But I think that the most likely scenario is that this is what I expect to happen in the next coming months.
Thank you.
Any EU developments you expect, just from an EU perspective? Do you think
Yes.
anything will be different for EU member states compared to other Pillar 2 jurisdictions?
We also expect the permanent safe harbor to be announced again before the year end, in order for the multinationals to be able to relax their compliance burden. The permanent safe harbor, it will be one of the, I would say, biggest contributions to this compliance burden, because if you cannot use the country by country reporting, the permanent safe harbor will effectively provide you the simplified calculations to avoid all these massive calculations that we see in the Pillar 2 environment. So I will say that the permanent safe harbor is something that it will be also very useful, and we expect this to come again before the year end.
Yes, and I guess as Professor Reuven said, watch out more developments next year before the elections in the US, the next set of elections. So there may be more on the side-by-side agreement. There may be additional issues to be addressed. But I think we're at this point where there is kind of, we are seeing this getting to at least a happy ending, or a happy first ending for the US and the OECD. Because remember, back in the summer, everybody was worried about revenge taxes and what will happen. And it was, and when I read about the article, I said, this can't be happening in today's world. So I think we are in a much sort of calmer Christmassy spirit, maybe, but anything is possible, I think, from what we've learned from the US side. Thank you very much, everybody, for attending our event, which was a little bit short notice, I understand. Thank you very much, Professor Reuven, for agreeing to talk to us. I know you're very, very busy. Thank you, Christos, for your wonderful presentation. And thank you to everybody who has attended. Please, we will send follow-up emails, and we will post, we will have the slides available to you. Also, please check out our other courses, our executive education courses, and our offerings at Queen Mary. Thank you very much, everybody.
Thank you all. Have a great day.